He knows that I have no problem telling someone they're wrong. We live in an era of fraud in America, not just in banking, but in government, education, religion, food, even baseball. I thought we were better than this. I really did.
Welcome back to the Big Long here. It's Sunday, August 22nd at 6 p.m. Let's go over what we missed for the weekend as well as the market outlook for the week of August 23rd. Let's get into why the slowing of demand might be a good thing for right now. Due to the lack of inventories, with stores and consumers only want to buy the things that they want right now, and obviously the retail numbers came in from last week that we went over are a little bit down from previously, which signaling the Fed to start tapering early than expected. So there was some good economic news when inventories across America businesses rose 6.6% compared to that 4.6% pace from a month earlier. And so while we look at the inventories to sales ratio, you could see it actually dipped lower in June to 1.25. And sales peaked at a record high in April and ever since then dropped 1.8% through July. So this is signaling that pretty much all the consumers satisfied their need of spending their money on the goods during the pandemic to right now. So, as long as countries are having strict COVID 19 procedures, as in shutting down ports, we're not going to see any supply chain fixtures anytime soon. Why? Because here are a few companies on their earnings call that have already displayed the supply chain problems and other uncertainties throughout the world, such as them not getting their inputs from China, Thailand, the United Kingdom, and even Australia. So the fact that they came and receive certain things that's bad for the company, right? If the company can't receive those goods, they can't produce anything for the consumer. Thus, what the heck is the consumer going to buy from them? Are they just going to spend their money to spend their money? No, they're not. They're going to want to spend their money on things that they want. Like I just previously discussed how the inventory to sales ratio declined. Now, we already, or consumers have already spent the money on things that they might necessarily don't need or just wanted because we were locked up so long because of COVID 19. But now, as things are reopening, even though the Delta variant is still strong and highly contagious out there, there has been more strict guidelines from other countries such as China, right? They closed down that port due to one employee testing positive. So that little closure right there is actually a huge economic impact on the supply chain. And you might not think of it as, wow, one port, who cares? I'm still going to buy whatever I can. But then when you go out shopping and you don't see anything, or your favorite store doesn't have what you normally buy from there, then that's when you start to realize that this is real and this is only getting worse and it's not getting better at the moment. So it seems like the market started to adjust to the Fed's expected policy tightening when the FOMC July meeting minutes came out last week, and they sort of hinted at they were looking to taper in the fall. Now, if the Fed actually falls through with this policy tightening move, this will be the first since the beginning of the pandemic, and this would really throw the markets for a taper tantrum, and that's not what we want at this very point in time. But let's see what our friends at CNBC have to say about the FOMC minutes.
That the minutes, they're going to be 3 weeks old, Joe, and both the data and the comments from Fed officials, they've progressed since then, and they should still, though, provide some clues to monetary policy. As we've reported, the Fed the Fed is coalescing around a plan to announce its plan to reduce asset purchases in September, but it is not a done deal. So we look to the minutes. for some information on how much support there is for the earlier taper, which is September, how much concern there was about inflation not being so temporary, and of course, the impact of the Delta variant. Fed Chair Jay Powell at the press conference said the committee reviewed different ideas around the taper, so there could be some details in there about how the Fed will reduce its asset purchases. And yesterday, Powell said it remains to be seen what impact the Delta variant will have on the economy.
So right there, he says that these minutes are going to be about 3 to 4 weeks delayed due to the meeting happening in July and the minutes being released last week. And according to Jim Polson, chief investment strategist, we started tapering back in March. And that could be true because the Fed has been hinting at some time about substantial progress. We're looking at our target inflation rate of 2%. This is only transitory inflation, and we still have a ways to go. But after the data being released last week, better than expected jobs and also worse than expected retail data, this could be a real indicator of the Fed tapering. So let's just see what Jerome Powell had to say about the FOMC.
Happened as the pandemic has continued is that people and businesses have improvised and learned to adapt, to live their lives despite COVID. And I would say it's
All right,
not
let's
yet
just stop
clear
right
whether
there.
the
He
Delta
said it's
strain.
unclear whether or not the Delta strain will have an impact on the economy. Now, we've heard him over and over again say that this is a variable, but it has had an impact on the economy. How? Through the supply chain, through jobs, through the way that we interact day to day, and just the whole psychological impact that someone may feel scared to go out or go back to work and to actually interact with certain people. Now, I know not everyone's like that, but there are people that are still fearful of COVID-19 and the Delta variant. And with people that are vaccinated and unvaccinated carrying the same viral load and getting people sick with COVID-19, I mean, I'm pretty sure that's having an impact on the economy. I mean, you could correct me if I'm wrong, but that's a huge, huge thing right there. So, the Boston Fed president says that the Fed should begin slowing down their stimulus efforts by the fall because of the strong jobs report if it continues. Now, this means that the Fed will start reducing the amount of mortgage-backed securities that it purchases per month, and they've been purchasing at least 120 billion a month to drive down the longer term interest rates to spur economic growth. And this is why you see rates at an all-time low historically, because the Fed is purchasing these assets, which is giving the banks the flexibility to be able to do this, to stimulate that growth and to let people take out loans to buy these overpriced houses or to take out loans for a personal reason to refinance in terms of like that situation. So as you could see, this is a quote from the Boston's Fed president. If you continue to purchase assets, the reaction primarily is in pricing, not so much employment. I don't think asset purchases are having the desired impact on really promoting employment. And what he's saying there is what the Fed is just doing is just pumping up the market so that the rich could get richer, and that's it. Because employment, yes, we had a great jobs number just previously with the 943,000 jobs, but when it really comes down to it, the Fed is just pumping up the market, and we're reaching all-time highs. And it's crazy when you actually read read the details because that is an insane important quote coming from the Boston Fed himself, saying what the Fed is doing is pretty much just pumping all the stock prices up. As you could see, that as the Fed's balance sheet's going up, stock prices are going up. So there's a little bit of correlation there that is pretty crazy in terms of stock prices when you want to compare employment numbers to those increase in stock price over the year. So as this week comes up and about, the Fed will need to avoid a taper tantrum as they meet at the Jackson Hole Summit in Wyoming this week to talk about monetary policy. So this is going to be the big key event to pay attention for, as I don't think they will talk about tapering due to the fact that the things I covered, there's not going to be tapering. Rosengren said it himself that what the Fed is doing is just pretty much propping up the market because they're buying that asset to allow that liquidity to be there to spur economic growth. So this is one of the key events that I'll be looking at. So let's get into the markets. Alright, as you can see, it is 8:04 p.m. Futures are up. You have the Dow up about 0.05%, S&P 0.08, as well as the Nasdaq up 0.13% going into the night. Now let's go over some Friday data. Alright, so let's look at some sector performance versus the S&P. So really on Friday, from a one-day perspective, the only industry or sector that was up are healthcare and utilities. Everything else from a day-over-day perspective was down. Now if we zoom out a little bit from a 3-month perspective, as you can see, everything is up, with consumer staples and materials pretty much in the bottom of the barrel. And then as we zoom out from a year-over-year perspective, everything is up. Everything is green. This is an everything is up market right now. But like I said, when you're looking at from a one-day perspective, it's only those two sectors that fell behind. So let's break down the sectors more in depth. Let's take a look at healthcare. So for healthcare, there was 589 stocks that were strong advances. That means up more than 2%. Meanwhile, there were 167 stocks that were down 2%, and 322 stocks were in between a quarter and 2% of gains. Meanwhile, 121 stocks were down between a quarter and 2%, and 114 stocks were unchanged. So utilities, there was 23 stocks up in strong advances, 70 stocks up between a quarter and 2%, and then 22 that were unchanged. Meanwhile, there was a total of 16 that declined. 6 of them were between a quarter and 2% down, while the other 10 was down more than 2%. So real estate, there was 167 that were up between a quarter and 2%. Meanwhile, 49 were up more than 2%. And on the bottom tier, there was 58 stocks that were down at least a quarter percent to 2% or more. And then we get down to consumer staples. So this is kind of even throughout almost. There was 77. Well, let's call it 155 stocks up at least a quarter, and 77 of them were up over 2%. 78 were between that 0.25% to 2%. Meanwhile, about 80 of them were down between 1/4 and more than 2%. And you could see the details right there. Materials, 128 were up more than 2%. Meanwhile, 77 were down more than 2%. Industrials, 207 were up more than 2%, while 298 were in between 1/4% and 2%, and leaving at least 93 and 74 stocks down at least 1/4%. And information technology, 234 stocks were strong advances. Meanwhile, 69 stocks were strong declines. For consumer services, there was 122 strong advances, up more than 2%. Meanwhile, there was 49 stocks that were strong declined of more than 2%. As we get to the financials, there was 217 stocks up more than 2%. Meanwhile, 455 stocks were up between 1/4 and 2%, leaving 44 and 88% of stocks declining at least by 1/4%. So getting to the energy stocks now, you're starting to see a little trend here that energy is up, and there was 105 stocks that were up more than 2%. Meanwhile, there was 59 strongly declined stocks of 2% down. And consumer discretionary stocks, there was 248 stocks that were up more than 2%. Meanwhile, there were only 68% of stocks that were strongly declined. So let's get into some stock movers. The biggest percent gainers, biggest percent losers, the highest volume traded stocks, top sector movers, as well as the bottom sector movers. So from Friday, you could see the percent gainers. The most was Cannabis Pharmaceuticals, up 521.31%, followed by Regencell Bioscience Holdings of 204.13%, with Flora Growth Corp in the middle there, and that's a company that I've been watching. Unfortunately, I didn't catch this last week because I was traveling due to work, but I will definitely be looking into that more this week. And then as you get to the percent losers, they're all down big. As you can see, it ranges from 54.77% all the way to 23.93%. Now, those are big decliners. And the highest volume, and now I pointed out one of these companies due to the option market, and that was NVIDIA. And I actually bought options on Friday for NVIDIA and made a decent amount, not a lot, but it was worth the trade. So I actually pointed that out in the morning. And as we get to the sector movers, the top sector on Friday was energy. And as you could see, the top changes in that sector range from 12.5% down to 8.91%, while consumer staples was the bottom performer of Friday trading day, and that ranged from 11.54% all the way to 5.15%. So let's get into some charts. Alright, so actually before we get into the technicals, I want to touch upon the options market real quick. So as you can see, the total put to call ratio is 0.91. Now that's kind of on the high side, pointing towards a more bullish to bearish momentum almost. Now 0.91, that could obviously drop or go higher in this next trading week. But as you look at the index put to call ratio, this has been over a 1 for quite some time, and a 1.75 is kind of high, and that is signaling a bearish momentum in the put in the options play for indexes. And then as you could see below that, the equity put to call ratio is pretty bullish at that 0.57 number. So as we get into it, the most active options that were traded on Friday were Apple, Nvidia, Tesla, Microsoft, AMC, Alibaba, AMD, and Pfizer. And so I actually pointed out three of these most active traded options, and that was Apple, Nvidia, and Microsoft. Now, I did buy options in all three, and I did actually trade all three last Friday. Now, this isn't financial advice. This is just for education on how I look at things and how I go about doing my options plays. So as you can see, the options volume for Apple was in the lead, as well as the put to call volume was pretty bullish, as well as Nvidia and even Microsoft. Now, out of all those, Tesla was the second highest put to call volume ratio. Meanwhile, Alibaba was the first. So those three that I named on Friday were my winners, and I'm still going to be paying attention to these three going into this week. And I'm still going to look into Tesla as well because of the Tesla AI Day on Thursday. Now, I do think that Tesla could make a run up again just because it's Tesla. Everyone loves Tesla. Me, I think it's somewhat overvalued. But then again, I'm not an expert. That's just my opinion. So now let's bring in the charts. Alright, so looking at the charts right now, I got the triple Qs, the SPY, the Dow, and the gold futures up. Now gold is down currently. Triple Qs are up, as well as the SPY is pushing up. Now, looking at the triple Qs, I have three support levels right here that I could see us falling to if we don't push to new all-time highs due to tapering being off the table, most likely. Now, I could be wrong. The Fed could come out after the summit this week and talk about tapering, and that could throw the markets for a loop. So you always got to prepare for the worst scenario. And looking at the SPY now, you could see from a weekly standpoint that we hit an all-time high, but we closed lower. And we touched that area of support. And if you've been watching my videos, that these lines have been there for quite some time now. So I really do think if there is another sell-off and we touch that level at 433, I do believe that we will go lower, as in that 423 range, and then as well as that 414 range. Now, there could be anywhere from a 5 to 15% correction, possibly. Like I said, I'm not an expert. This is just my opinion. But as we look at the Dow, so the Dow, you could see we have touched that 344. Yeah, the 344, 346 line, a decent amount. We were trading at that line for a little bit of time from the weekly time frame, and then as well as the 335.6 level. We did touch it and break through it twice, but then we came right back up and pushed all-time highs. So with volume being a variable and the seasonal trend happening, could stocks dip off between now to October a little bit more? Yes, it could, but it's not a normal market like it used to be. Now, markets could really tank during this time. Why? Because you have the Delta variant, you have tapering talks, you have the seasonality trend, you have all these factors that are normal, but the real two biggest ones are tapering and the Delta variant. Because as the Delta variant stays and pretty much doesn't go away and everyone is still fearful, that will give the Fed the reason to keep on pumping the market and giving it the juice that it needs to keep on rising. So that's my take. I think tomorrow we actually might go green. Mondays typically is a good day of volatility to start off the week, but then we're getting into the final days of August. So Monday could be a good indicator of where we're looking at for the rest of August in terms of price action. For those of you who tuned in, I appreciate it and thank you. Hope you learned something. Tomorrow morning I will be going live. Also,